Welcome to NDTV Profit. I'm quickly going to take you through earnings and we're going to focus in on L&T Finance. Numbers coming through and another maybe one-off, but outside of that one-off, it's a decentish set, slightly on the stronger side of things. But to give us more perspective on Q4 and the way ahead, we have the new MD and CEO at L&T Finance, Sudipta Roy, joining us to try and give us all of that perspective. Good morning, Mr. Roy.
Good morning. Good morning. Thank you for having me.
Mr. Roy, it's our first interaction. So firstly, many congratulations on your appointment as MD CEO at L&T Finance. And we hope and wish you a very happy and successful tenure.
Thank you so much. Thank you so much.
Right. Sir, let me first start off with the one-off. Talk us through what exactly has happened with regard to the excess provisioning of around 175 odd crores you've made with regard to SRs. Is this purely a one-off? Is this relating to a specific set of SRs? Talk us through what's happened.
Yeah, so thank you for the question. Before I sort of get into specifically in the question, I'd like to give a brief summary on our performance. I think the performance has been pretty satisfactory. If you look at our disbursement growth has been quite strong. Our retail disbursement growth has been 33% on a year-on-year basis, as well as our retail book has grown by about 31% on a year-on-year basis. Now, and what is important to know that actually on a sequential basis, we maintained our disbursement growth at about 4%. Typically, the Q3 is the festive quarter, so we've been able to maintain that particular growth on a sequential basis, which is again because the disbursement engines that we have fine-tuned and built over the last couple of quarters actually held their momentum in Q4, ending up in a disbursement growth more than that we saw in the more than that we saw in the festive quarter. In terms of our cost of funds trajectory, the cost of funds trajectory remained extremely stable with only 1 basis points increase on a quarter-on-quarter basis, as well as our asset quality also remained stable, improving sequentially. In terms of the update on our Lakshya strategy, we are currently at about 94% retail, and our wholesale book is actually pared down to about 5,500 crores. And that brings me to your question. See, when we started our wholesale journey, we had about 38,000 crores of wholesale reduction journey. We had about 38,000 crores of assets on an overall basis. And over the intervening years, we have run it down to about 5,500 crores as of now. We had done our valuation of the fair valuation of the wholesale assets when we had started our Lakshya journey, and we had kept aside about 2,600 crores worth of pool of money received from the gains proceeds from our mutual fund asset sale. And we had kept that money aside for what we called illiquidity discount at that particular point in time, which means if we were to sort of pair off an asset and if the buyer needed a little bit of price advantage, we would dip into that illiquidity discount. Having run down the wholesale book from a 38,000 crore odd level to about 5,500 crore right now, we did a fair valuation exercise of our wholesale on-book wholesale portfolio, and that yielded a release of about 546 crores. You are also aware that we have been periodically some of our assets have been periodically vested off to the ARCs. So we have an ARC pool as well. When we analyzed our ARC pool, what we came across is something what we call sequence risk. That means, overall as per our sort of estimations, though on an overall basis, on the entire resolution pathway of the ARC pool that L&T Finance has, the organization will probably end up making a reasonable surplus, right? But however, there exists a sequencing risk. And let me explain for 30 seconds what is the meaning of sequencing risk. That means, for example, if you have a ARC asset that in its pathway to resolution, if you are required to take a markdown temporarily of about say 10 crores in one quarter, and then in the next quarter there is another asset that resolves which gives a 40 crores gain, for example, on that asset. So on a 2-quarter basis across these two assets, L&T Finance actually ends up gaining 30 crores. But because the 10 crores markdown comes before the gain comes, this leads to something called a sequencing risk. Now, when we analyzed our SR portfolio, we wanted to protect our quarterly earnings and our go forward trajectory from any of the sequencing risk actually distracting us from our retailization journey that which has been going quite strong. So what we have done is that we have taken the 546 crores that we got as a release from the fair valuation of the wholesale assets as of now, and we have added 175 crores through the P&L to create a floating provision of roughly about 720 crores, which will hold at a portfolio basis, which we can use against any of the SR assets to take care of the sequence risk. As of now, we are quite confident basis the data available with us now that this 721 crores is quite sufficient to address the sequence risk arising of the SR portfolio. As you know, there has been a sharp uptick in the commercial as well as the residential real estate cycle, and resolution pathways of many of these SR assets are currently visible. And as a team, we are now focused on resolution of these assets, and this particular floating provisions gives us a lot of peace of mind sort of while we go along to address the sequence risk, while we go around resolving the SR assets. But however, the focus of the entire organization is going on the growing the retail side of the business, which have been doing exceedingly well, and we are very certain that over the next couple of quarters, as we continue our focus on resolving the SR assets, the SR assets will also show a sort of a positive resolution trajectory, and in the end, over the next 4 to 5 years time frame, we are very confident that we as an organization will actually end up with a reasonable surplus from the resolution of the SR assets.
Okay, so really long answer there, but thank you for that comprehensive picture with regard to what's happened on the one-off side of things and what sequencing risk means. That I'm sure would have given viewers a perspective. But really the key question here is, of this 700 plus crore, what's the kind of recovery one can expect? So while you've written it off from a prudence perspective in this quarter, can we expect pretty much the whole amount to get recovered eventually once all of the resolution proceedings have ended for you?
Yeah, so as I said, because of the buoyancy in the commercial and real estate cycle, resolution pathways of many of our SR assets are currently visible. So, you know, over the week, our teams are working very with a great amount of focus on these resolution pathways, and you know we will start seeing cash flows in some of these assets as and when they move towards resolution. As you understand that, you know, real estate projects are complex projects, and revival in real estate scenario in the country has given us that window of opportunity now. But this is not something which happens in 2 months or 3 months. This is a process that takes a couple of quarters, maybe at times 3-4 years, for example, for the entire project resolution to happen and the entire cash flows to starting to happen. So I'll reiterate what I said in my initial answer, that, you know, looking at the current pathways of resolution and looking at our current, as we stand, our current assessment of our SR portfolio, the organization on the long run will end up sort of gathering a reasonable surplus over our SR assets. This 720 crores of floating provisions that we have created is just to smoothen out any sequence risk and sort of protect the quarter trajectory of the organization from any sequence risk. Our focus is on retailization, and as a team, we do not want to be distracted by this quarter-on-quarter sequence risk. We want to focus on retailization. We want to sort of maintain a positive trajectory of results delivery, and we are reasonably confident at this point in time that this 720 crores of floating prudential provisions that we have taken gives us enough cushion and peace of mind to achieve that.
Sure. So, you know, quick last question, which I'll have to throw in here with regard to both margins. Margins have gotten better, but ROAs are seemingly below your target ranges. 2.8 to 3% is your target. What are the levers for ROA improvement from here? How quickly can ROA improve, and where do margins go?
Yeah, so if you see, the composition of our portfolio has been changing. You know, previously when we started the Lakshya strategy, we are almost, you know, 50-50 between retail and wholesale. But as of now, we are 94% retail, and the retail margins, especially the retail NIMs, are almost close to 400 basis points higher than that of the wholesale NIMs. So the trajectory of our portfolio has been changing. As you are aware, we are at a sort of high cost of funds regime right now, and we expect that the cost of funds regime to remain at this level for the next couple of quarters. Our overall ROA trajectories have been improving. In fact, our retail ROAs, we have almost achieved the retail ROA targets that on the Lakshya targets that we have set of about 2.83%. On the retail side, we have more or less achieved those goals. So that is why we have reoriented ourselves to target those console ROAs of 2.8 to 3%. Now, as an organization, the guidance that we have given is that exit FY25, we'll try to work towards that 2.8% ROA, and exit FY26, we'll work towards a 3.3% ROA. Obviously, ROA balancing is a combination of many factors. It's a combination of your NIMs, a combination of your credit cost, as well as a combination of your expense lines. So we will continually work through every quarter to optimize all of those lines, especially on the credit cost line as well as on the revenue side as well. And we are hopeful that we will, as an organization, will maintain a positive trajectory as close as possible to the Lakshya guidance that we have given, and now that we have reoriented ourselves on a console basis to that 2.8 to 3% threshold.
Sure. Thank you so much, Mr. Roy. That's all the time we have today with regard to the earnings of L&T Finance. Thank you so much, sir, for that perspective. Of course, larger conversation merited and warranted, and we will have that later on, maybe in a week or two with you. Thank you, sir, for your time. With that, completely out of time on this edition of the show.